Hi, welcome to the Market Alert for Monday, the 8th of January 2018. Recording this on Sunday because there's a couple of pieces of news that have come to light, which I thought I would share, and if it goes over a bit, that's fine. Friday, starting off with the pound, you can see this started off lower. Then we had the non-farm payroll figures, which I will just jump to so you can see those. They came out far worse than expected. As you'll see here, forecast at 190 came out at 148 there, previous 252. Of course, that doesn't matter. Keep moving the market higher, and that's precisely what they did. The dollar moved lower, and again, let me just see if I can grab that, bring it into here, get rid of this, and then somewhere in here we've got the dollar. So you can see the dollar there sideways. This is the daily chart. It is indeed, yeah. So again, watch this level down to the 90 on the dollar index, because if this breaks, as you will see from the weekly chart, as I've already shown you, we've got a long way down to this level, and Trump wants the dollar down. So again, keep that in mind as well, and that's going to add, of course, to the pound moving higher, which we've been moving higher for a while now. We do have the odd down days, which you're going to get, but on the whole, you can see that the market is actually moving to the upside there, following a retracement here down to this level. Ever since then, we've been moving higher with a bit of a pullback, and then heading up towards this level here, just 136.56. If you're long, watch that level, because you'll need to see the market drive through this in order to move higher. Now on the Dow, well, it's relentless, isn't it? Just go back to the non-farm payrolls, and you can see they came out, and the market did move lower for a bit when it opened up, and then eventually normal surface resumed, and we see the market moving higher. And then in the evening session we see really piling on the pounds there, no pun intended, but yeah, pounds or points make pounds in this situation. You can just see continually driving higher. We're now sitting on a new all-time high, no surprise there, and this is going to continue, and I'll show you why in just a moment. We've got 25,302. That's over 300 points in the last few days. Which brings me to this article. Get rid of that. I need to click on that. We'll start off with this. Why, for stock market bulls, Monday could be the most important day. And the reason for this is, as it says in this article, the holiday shortened first week of 2018 was the best start to the year for the Nasdaq since 2004, with all major indices up every trading day so far this year. So from the 2nd of January, the markets have been higher. Just to get this in the right place. Between the last week of December and the first week in January, Bloomberg reports that the S&P 500 has reversed direction every year since 2011, i.e. moved to the downside. However, possible explanation for this is the expiration of government policies on December the 31st. However, after the 4 trading days, the S&P is up 2.6 year to date already. That is the best start of the year for the S&P since 2006, and who would have been and would have been the best weekly gain in 2017 as well. However, critically though, as Ryan Dietrich notes, since 1950, when the first 5 days are up over 2%, the S&P is high for the year 15 times out of 15, so that's a 100% record, with an average return of 18.6. So as the title of the article, the headline, so as Dietrich concludes, if you are bullish, Monday is a big day. So if the market finishes higher on Monday, then that's going to set a precedent. We have a record of 15 out of 15 times if the market is above on Monday, holding that 2%. So again, as the article goes on, it doesn't mean that get the right tool there. It doesn't mean that the index will go straight up from here, but the economic fundamentals are strong enough to support the stocks. Phil Orlando, chief equity strategist at Federated Investors, but he has a vested interest in saying that, of course. Corporate earnings as well, which are due out this month as well. Seen solid growth in the last 9 months. We expect another double digit in the fourth quarter. The party is going to continue. And after setting so many records last year, sentiment trader Jason Gopfert expects 2018 to score even more. Among them, all the major indices haven't been more than 5% from a 52-week high for nearly 400 days. Classic parabolic move, and move to the upside as well. And this is another great paragraph here as well, and one to sort of heed. It feels like the late phase of a bull market. It certainly does, which investors are capitulating on their reluctance and joining the party because they cannot identify any downward catalysts. This is the FOMO syndrome, fear of missing out, said Matthew Lifton, portfolio manager at Columbia Acorn Fund at Columbia Threadneedle Investments. Instead, investors see lower corporate taxes ahead, global economic growth accelerating, evaluation on post-tax reform earnings that is palatable. I'm going to come to the final paragraph here. I'm not going to read this one to you because I'm going to go to this article also, but first let's just have a look at the implied volatility, then I'm going to come back to this. So on Friday we've see the volatility move up just slightly, but we can see from last year this market has been in the lows sideways for a very long time. And if we go to the 10-year chart, which I'm just going to click on now, as we've said before, there is a definite downtrend there, and there is a range of this market from 2012 down to these lows over here that we have seen being made during the last year. And fortunately, Powell, who's the new Fed chair, who's going to be in from February, last week they released the minutes from 2012, and it makes for very interesting reading. Let me show you. So old Powell, you'll see the admission here, the headline, Fed Chair Powell's admission. The Fed has a short volatility position. And how many times have I mentioned this in the last few years? Volatility used to be fantastic to actually predict where the market was going to go when it got into the lows. It creates complacency. The market then has a correction. But, of course, it can't do that if there is manipulation of the market. And I've said this for a long time. I've shown you charts of the VIX where the volume has increased considerably, and let me just bring that up and just remind you of. So here you can see the monthly chart of the VIX, and from 2012, sure enough, you start to see an increase in the volume there. It's blatant, and you've got a downtrend in the actual VIX there. And this is what their admission is, that that's exactly what they've done. And as this article goes on to state, for years, market watchers and Fed skeptics had warned that the record low volatility blanket that has fallen like a pall over the comatose market was the result of the Fed's actions. That's me. I was told by a few people that it was just conspiracy theory and all the rest of it, but yet again, it's just blatant what they're doing. And people tend to forget that with the computing capabilities that are out there now, anything can be distorted or manipulated. And again, if you go back, although back in 2012 we observed the distinct shift in VIX futures when current head of Fed's trading desk Simon Potter replaced Brian Sack. We now have explicit confirmation that the Fed short vol position appears to be rather literal. So Powell replaces Yellen. And this is it's just lovely to read. This is, it says, I have concerns about more purchases. This is back in 2011, I think, 2011 through to 2014. As others have pointed out, the dealer community is now assuming close to 4 trillion balance sheet. This is on the Fed's balance sheet, and purchases through the first quarter of 2014. I have to admit it is a much stronger reaction than I anticipated, and I'm uncomfortable with it for a couple of reasons. First, the question is, why stop at 4 trillion? The market in most cases will cheer us for doing so. So they want, if they print more, the market will go up. Of course it's going to go up because it adds liquidity to the market and then drives it higher. That's exactly what this market's moved on since March of 2009. It will never be enough for the market, no, because they can keep just using it and pumping it into the markets. Our models will always tell us that we are helping the economy, and I will probably always feel that those benefits are overestimated just a bit. You just created asset bubbles. And we'll be able to tell ourselves that the market function is not impaired and that inflation expectations are under control. Not from 2018, they're not going to be, son. What is to stop us other than much faster economic growth, which is probably not in our power to produce? No, it's not. You've not had over 3% GDP all the way through Obama, and you're not going to get it through Trump either. And then the punchline. When is it time for us to sell or even stop buying? The response could be quite strong, i.e. QEs don't print anymore. There is every reason to expect a strong response. Yes, you stop printing and try and offload the balance sheet and the market's going to go down. So there are a couple of ways to look at it. It is about 1.2 trillion in sales. You take 60 months, get out 20 billion a month. This is a very doable thing. It is in small amounts, and it sounds like a market where the norm by the middle of next year is 80 billion. So they propose an 80 billion offloading each month to get rid of this 4 trillion, or in this case 1.2. Another way to look at it, though, is that it is not much of a sale. The duration is also unloading, and this is the bit I was after, actually. Just highlight that for you. Another way to look at it, though, is that it's not so much the sale, the duration, it's also unloading our short volatility position. So until they unload the short volatility position, or even start to, this stock market is going to move higher. I'm going to spare you the rest of it, but this was also in the other article about the market continuing to move higher, and this is the beautiful reply of Powell. This is your new Fed chairman. I think we are actually at the point of encouraging risk-taking, well, slightly, and that should give us pause. Investors really do understand now that we will be there to prevent serious losses. I mean, under the illusion that you will prevent serious losses by funding banks that go bust or on the verge of going bust. It's not that easy for them to make money. No, it's not, because the rich keep getting richer. But that they have every incentive to take more risk. They have to take more risk to try and fund their pensions, so they've got something to retire with. That's why they have to take more risk, and they are doing so. So that's where you get that capitulation that we just spoke about in the other article, where they will move in and buy whatever they can buy based on whatever Trump tells them, how well the economy is doing, etc. Meanwhile, we look like we are blowing a fixed income duration bubble. Yes, the bond market's starting to suffer. The yield curve is starting to flatten right across the credit spectrum. That will result in big losses when rates come up down the road. Yes, well, they've got to increase that because you're going to see inflation move higher in 2018 as well. You could almost say that this is our strategy. Well, thanks a bunch, Powell, because what you're going to do is to blow the biggest bubble. When I mean blow it up. And from this parabolic move, when it does eventually burst, then it is going to be catastrophic for those people, as it mentions in this article here, that were buying more risk or prepared to take more risk than they are doing so, purely and simply to make sure that they can get some sort of return out of this market. So the consequences are going to be devastating, but when you actually knit all of this rhetoric together, and well, not necessarily rhetoric, but from the FOMC report, you will see that their goal is to continue to blow the bubble, keep moving the market higher, and it may seem odd to say that we could get to 30,000, not at all when you see how far the market's come this year. And let's just have a look how far the market moved higher this year. So the Dow this year has moved over, as you'll see there, 4,649 points. And at the rate we're going, you can see where it put most of this on as well. It was in the the third and fourth quarter. And you can see the market continuing to move there as well. And again, you can see here, which I thought was distribution this time last year, of the big money getting out. Completely wrong on that one. Hold my hands up on that. That's generally what that is a sign of. But now you'll see from that other article that this is the sheep coming in and buying the market for the fear of missing out. This will be the institutions, and as the latter part of this, you'll start to see the general public frightened of missing out on the move. So here we've got 4,600 points, and we're heading towards 26,000 now. So it's not unattainable throughout this year, if it does continue, of course. I mean, there can be outside influences like Trump going to war with Iran. That seems to be on the cards now. And also you've got Rocket Man, that he refers to as a North Korean president as well, where there could be kicking off there as well. Plus he's made Jerusalem the capital of Israel. The tensions are building there in the Middle East. Keep an eye on that as well, looking at geopolitical events building up. So apart from those things coming on stream, there's no reason why this market won't continue in the short term. How long it lasts, well, we'll have to see. It depends how quickly they can blow it to the upside. But don't forget, they've got to continue to raise rates, offload the balance sheet, and at some point the elastic band and the bubble are going to snap and burst. Right, let's have a quick look at the other bubbles in the world. Let's have a look at Bitcoin before we conclude. So Bitcoin trades 24 hours a day, 7 days a week. It's fairly quiet over the weekend there, which you can see, but we've broken the high that we had in place here, driven through this on Friday, also through the 76% retracement that I put in there. So what I'll be looking for now is this market from the recent high down to the recent low, and oddly enough we're nearly in that range as it is. So again, watch the market at this 76%. It's got to drive through this in order to get above the all-time high, and then drive through there if it's going to continue higher as well, and I would imagine that it will do. Not consolidating as much as I thought it would. I thought it had been range bound for a bit longer than this, but it doesn't appear to be the case. The market is moving towards the highs again. Let me just remove this off the chart just to make things a bit clearer, and then drag this back so you can see where we are going in this market. And that's the Bitcoin analysis there at the moment. A nice trend to the upside again as well. Okay, that'll do it for this one. If there's anything to report, I will let you know. Other than that, as ever, thanks for watching. See you in the next one.